Hello traders, what's going on? So for today's session, this is not really like a ad hoc market update session, but rather I have some stuff that I want to share when I am looking at the market. And of course, the main thing is that yesterday, the US market dropped about 1.57%. For Nasdaq, S&P, and the Dow Jones itself, I think all of them fell about the same level. So we do have selling across all sector, not just the tech sector itself. If the selling happen in tech sector, what you will normally see is the S&P and Nasdaq, the Nasdaq driving a lot lower than the Dow Jones, but we are also seeing Dow Jones going down in a equally amount. Okay, so I just want to explain what we can deduce from this sell down. And in fact, this sell down is very timely because it is at the end of March. It was the last trading day for March. Not only that, it is the end of Q1. So we do have a lot of, I would say, window dressing happening. If you look at Apple, which we have gone through in our last video, Apple actually went up 11 green days in a row, and each of the green is about 1 to 2% in increment. And finally, we have some red candles showing up. I mean, definitely it was due for some form of retracement, but it does break the winning streak. So the key topic for today is very simple. Is this the so-called return of the bear? Are we going all the way down to break the previous low that we have during February, mid-February, like that? Or is this like a short-term retracement and we can kind of like hope for a further rally towards the all-time high? So of course, with the information we have right now, we definitely cannot predict anything or sort of make any trade right now. So I'll just go through in a very organic manner, and I just share my view on what I think, and there are also some interesting stuff that we can take a look at. Okay, so towards the S&P 500 first. So let's look at the cash market. Okay, the cash market. Let's not look at the futures because the futures candle are a bit hard to read lah. So let's look at the cash market. Definitely, we have some kind of resistance here. The resistance was formed sometime in February and late January and early February. Okay, so these were the two so-called resistance that was formed. These were higher lows. So now, previously I mentioned that S&P broke above the resistance here, and this one is now created a higher high. But let me retract that statement after looking through a bit, right? I want to retract that statement because sometimes when you are trading, right, you have to understand that things are not always one-to-one. Things are not always in a if A then B, that kind of situation. What I mean is, for example, you cannot always simply look at, okay, if numbers go up, then stock market go up. So in one example I can say is, if let's say interest rate go up, then stock go up or stock go down. Or if the non-farm payroll went up, then stock should go down. So we cannot make that kind of one-to-one comparison like that. Stock market is a lot more complicated. And if any kind of this one-to-one, if A then B comparison and analysis works, right, then everyone will be a billionaire already. There will be a lot of trading algorithm running around just to trade based on this kind of one-to-one comparison. Okay, so this is something that I constantly drill my trainees who come for my course. But let's get back to S&P 500. So the reason why I say this was I want to retract that statement is because the price actually cheated in the sense that it gap up. So it kind of like didn't really get resisted there. It kind of cheat their way by hopping through the resistance line. And this gap up, I'm sure by now you all should already know, it was sort of led by Tesla with their famous stock split news. And also it was led by Apple itself. So all these big weightage counters that which lead to the S&P itself gapping up for that particular day lah. So the thing with this gap up is that I will think this resistance is valid if it can gap up and then it managed to retain the support, retain this resistance as a support. But what happened was it was supported on Wednesday, but on Thursday, right, it just dived all the way down. So on Wednesday itself, I will be a little bit more, I would say, agreeable that now 4600 is now retaken. We are going for a higher high, and this candle here have actually created a higher high, and the price was clearly supported. But now Friday, when Thursday come around, right, the price just broke through it. So the way I'm gonna interpret this is that this is not really a higher high because they are just cheating the price level and now that it has broken through. And of course, if let's say this particular gap up is a lot higher, like maybe somewhere here, right, then regardless whatever the breakdown was, I will still consider this as a higher high lah. But now this so-called higher high was a very tiny amount. It's close to about 1% from the previous high. So it's my personal interpretation. However you want to interpret this is up to you. So what if we were to follow my interpretation, right, what we will have is like a double top that is being formed here lah. But regardless whether is it a higher high or is it a double top, right, what we want to know is if this price is going to create a higher low. Okay, it can create a higher low and continue to gap up. So the thing about higher low is that the same with a higher high, price can actually retrace anywhere from this current price level, which is at 54530, all the way down to as low as maybe perhaps 4250, and it can still be considered a higher low. So for example, this is still a higher low, this is a higher low, this is a higher low, this is a higher low. So anywhere it retraces, right, between these 2 points, I will still consider it as a higher low, and I will say perhaps the chart remain bullish for now. So the key thing here is for those who want to buy this higher low, right, we don't really know where is the higher low yet. And you do not really want to prematurely run into the buying side. Let the price fall, let it create a support first before you decide to buy into the market. And of course, we can somewhat have a rough prediction on where this higher low is going to be, but it is a rough estimate. It's not going to touch the price and then immediately move up. So there's a lot of market dynamic involved. And that level is, of course, somewhere around here. So this is the level that we can kind of predetermine. If price come down here and we start to see bullish candle forming, right, then yes, okay, we will have a higher low here. But the thing is, back to my original point, right, it can be anywhere. It can be anywhere as long as the price is above 4200, right, it is considered a higher low. So it can like just rally back up today also, then we have a higher low also. So now the key thing is, if you have been bullish in the market and for some reason that I don't know, you only buy in right now, and most likely you might buy in because breakout of the resistance, and this is where I feel that the market cheated lah. Okay, so if you only buy into this so-called bull recovery, then you are actually carrying a lot of risk. You are carrying a lot of risk, even if the chart takes a higher low, or even if the chart managed to remain bullish and manage to form a higher low, right, you are looking at a drop as low as 4,200. Are you willing to take that kind of drop or not? Or if you want a little bit more conservative, we look at the previous support resistance level. Okay, so meaning you need to stomach around at least 130 points drop in S&P 500? Are you able to stomach that if you bought at the high? And I mean, what I'm trying to say is price can drop to as low as 44,000 or 4,400 or 4,200, and it can still remain bullish. It can still be considered bullish. So if you buy at the top and you see this big drop down, right, you might be like panicking already. You are losing a lot of unrealized loss. You are taking a lot of unrealized losses, and you are thinking like, hey, I thought chart is bullish, this and that, but actually chart is still bullish. It's just that you entered at the high. So if you are already in the long trade at the high there, right? What you may want to do is you may want to hedge your position a bit, or you may want to trim your position a bit and see how you can go about it. Because I don't really have a concrete advice for you, mainly because for my kind of play, I definitely would not be buying. In fact, for those who have been watching my YouTube, or for those who come to our usual AMA session and webinar, right, my overall macro sentiment is still on the bearish side, although I have a few long positions here and there, but my overall sentiment is still bearish. Of course, bearish doesn't mean I'm always shorting 100% of the time. During this period, I definitely did not enter any new short, although my current shorts are still surviving very well with in the money profit, but I'm not trying to short the top for Apple or Tesla or doing that kind of action now. Okay, so these are the things that you need to take note of. So with regards to S&P 500, as a bear, I am quite happy to see some form of retrace coming, but I am also very well aware that there can be a higher low and market can actually rebound and maybe create another high. That is definitely possible. Even though my sentiment, I feel that within this year, it might be very hard to break the all-time high that was achieved in early January, right? It might be hard, but I need to also consider that it is a possibility. Regardless how low the probability is, it can still be a possibility. So I must make sure that my trade is my portfolio, my trading portfolio is not like too heavily weighted towards the short side. So that's very important on a portfolio level also. But of course, if you are an investor looking to invest for a 20, 30-year time frame, then my video is not for you. Don't come and tell me things like, oh, just buy the dip just buy the dip, buy Apple at the dip, buy Nvidia at the dip, buy AMD at the. Yes, you can do that. If you're a long-term investor, you can definitely do that. You can just buy the unit trust, dollar cost average, whatever. But we are more of a mid-term trader. Our trading time frame is usually from 2 weeks to about 2 months, like that. We don't really scout short-term movement, but we also don't hold until like 4 or 5 years. We are not investors, okay? So I hope I made that clear. Now, let's go on to look at certain specific sector, okay? I just want to talk about yield curve a bit, but I think by this time you all should probably hear of yield curve everywhere on the social media until like really sick of hearing already. But once again, right, the yield curve itself is a leading indicator, meaning it is not like the moment the yield curve invert, the crash is immediately going to happen. It's never like that. That's the issue with leading indicator. They are leading. So stock market only tend to follow up like a few weeks, a few months, or even a few years later. Okay. So don't always have that direct, very tunnel vision mindset where, oh, yield curve invert, but how come stocks are going up? That is a very, very narrow mindset, and it kind of have a it gives the impression that you don't really understand what the bond market is and how the whole bond market works. So we need to be very careful about macro data also, because macro data are more of a top-down, I would say, a higher level view of data, higher level in the sense that we are looking at it from a broad perspective. It cannot be used to time the market. It cannot be used as entry signal. That is why we still look at chart. We still look at technical analysis to do entry. So we cannot look at something like, say, the yield curve invert and then you immediately start shorting. or we cannot say that suddenly the Federal Reserve balance sheet has reduced and then we start shorting. So these are not entry indicators, okay? But rather what these are is it will provide you with a more of a longer term biasness. So when you see the yield curve invert, right, maybe it will kind of lead you to think that, okay, maybe things are going to be bad about 6 months from now, 1 year from now. So I have to be very careful not to be aggressively long in all the growth stock, and I might want to pull back a bit, and you might want to switch your portfolio into something more defensive in nature, like, I don't know, buy some defensive stock like Lockheed Martin or some soft commodity. So it gives you time to adjust your portfolio. Okay, it is not like it invert that all like the world is crashing already. It's never like that. So I just want to make that clear. But also to point again on the yield curve, it went below zero again last night. So it actually went below zero around like this period. So we kind of like hit the zero second time already. So when it hit the 2 times, right, the 10 minus 2 yield, it means that the curve has inverted. So the thing that we want to see is whether is it going to continue go down and then spend a lot of time under the negative level, under the zero level, or is something gonna happen that will make this whole thing recover and then the yield curve is back to normal. But what you have to know is that previously, when the yield curve recovered here, right, it was because the Federal Reserve reduced their rates. Okay, the Federal Reserve saw the yield curve inverted. They realized the economy is not really doing very well at that time. So Federal Reserve came in and reduced the interest rate. So the yield curve actually kind of like improved. So let's take a look at it. The yield curve inverted back in somewhere around 29 August 19. Okay, 29 August 2019. That's when the yield curve inverted. It went below zero. Then let's look at the federal fund rate. Okay, so 29 August 19. Okay, let's look at August 19. So somewhere around August 19, which is like right here, August 19, somewhere right here, Federal Reserve actually reduced the rate, and then even at December they reduced the rate. They reduced the rate in December 19. Remember, that's still December 19. COVID haven't happened yet, but Federal Reserve already reducing the rate to sort of ensure that the economy doesn't fall into recession. But eventually it still fall into recession because of COVID-19. So what I want to say is back then, Federal Reserve have the option to reduce the rate, because when the yield curve invert, the interest rate was at 2.00 or 2.5. But right now, they can't do that anymore. They can't reduce the rate. So most likely we might start to see this lingering below the 0% for very long. And the longer it stays below 0%, right? The longer it stays inverted, the worse it is for the economy. Inverted yield curve means banks are now very under pressure. They are unable to loan money really, or it's not profitable for them to loan money. They will stop giving loans. It's either that or they need to charge astronomically high level of interest that nobody want to take the loan anyway. So with all this, right, the money supply in the market is going to get reduced, and then on top of that, Federal Reserve is gonna increase the rate even more, because now they just increased the rate 2 weeks ago, and now they are going to increase even more to fight inflation. So these are all very long term. It takes a while for all these things to plays out in the real economy, and then eventually the stock market will be hit. But at this time right now, even with yesterday price action, right, it is still somewhat bullish. It can create a higher low and then continue to rally upwards. It can still it is still in that bullish mode, but eventually or the impact, the repercussion from the inverted yield curve will start to take effect, and you will see the stock market start to face pressure also. Okay, I hope you guys can understand that. Next, we also have a situation where oil price is coming down. Okay, oil price is coming down as early as 25th March. So this one, I'm not sure, you can kind of treat this as a lower high. in a short-term time frame, and then it can bounce back up. Or maybe this is a lower high and then it will continue to go down some more. We don't know. But the important thing is now we have a situation where oil price is going down at the same time as the stock market is going down. So previously we have a situation where oil price go up, stock market down, or stock market up, oil price down, because it has a lot to do with the Russian-Ukraine conflict. But now it kind of seems that it has been decoupled. It's no longer correlated to each other. The stock price down, oil also down. It does seem like it. Of course, we probably need a few weeks, a few more months, and we need to wait how the Russia conflict plays out. Also, now we are in April the 1st, and we need to see how's the treaty with the Europe nation going, because now Putin is demanding the unfriendly country to pay for the natural gas or oil in rubles. So we don't know how that plays out here. That might affect the oil price also. But for this brief period, right, for this week that we start to see the stock market going down at the same time as the oil price are going down. So that's something to be aware of. So doesn't mean I share something, it's like, oh, so we buy, so we sell. It's not always that. You take the knowledge for what it is. Just be aware, okay? Just be aware. Next, looking at the sector fund. This one I shared a few times already, but I want to emphasize again. The home builders. Home builders is the first sector ETF that actually breaks below the February bottom. So this February bottom is a very strong bottom. Everything rebounded like crazy. So if you look at all the sector ETF, right, we have a very strong recovery from the sector February bottom, consumer staple February bottom, strong rebound. Hey, sorry, this was March, my bad. The February bottom, very strong rebound. But for consumer staple, it broke briefly. It broke briefly right before the FOMC announcement, the meeting, and then it just recovered. And energy sector still at the all-time high level. Financial, we also see financial breakthroughs, much like the consumer staple, right? Financial sector also break through the February bottom right before the FOMC meeting on 16th of March, and then it start to recover. Industrial sector, same thing. But for home builder, right, it broke through the February bottom, but unlike the other sector, right, it didn't really rally much during this so-called one of the most aggressive rally that we've seen, one of the most so-called I don't really want to put a label on it as a dead cat bounce, because maybe a lot of people might disagree, but in my heart I take this as a dead cat bounce, okay? So unless it broke through here, it is a dead cat bounce. Okay, so I mean, what I'm trying to say is, among all the sectors, right, the home builder sector is actually facing one of the worst performance in this period in March, where almost every sector enjoys some kind of a relief rally. Okay, yes, relief. I think that's a better term to use. Almost every sector enjoyed a relief rally, but the home builder is doing very, very bad. In fact, even as early as February, right, we were looking at the home builder sector on the news that the interest rate are going up. We have supply chain issue, commodity prices going up like lumber, copper, all this, right? Home builders, their profit margin is truly affected by these high commodity prices. And not only that, now with the mortgage rates being all-time high, right? Most likely the demand for homes is going to decrease, and we will start to see the stock start dropping left and right. So earlier in February, around that period, although we were kind of like feeling bearish already, but most of the home builder stocks, they aren't really breaking any support, and in fact they were quite bullish. But right now, a lot of those home builder, home furnishing stocks, right, they have break through their support, and we actually have short position on it already. So if you kind of like want to know more in a timely manner on what are the counters that we are trading, do join our Patreon. We share a lot of things in a more timely manner, and also you will see which are the stocks that we are trying to trade or we are looking to trade. Another thing that I want to point out is also the utility sectors. The utility sector. So in the past 1 week or in the past 2 weeks, utility sector actually break through the resistance and went into an all-time high mode. So this is the only sector that is in the all-time high mode. Energy sector kind of like retrace a bit, but actually it's not even all-time high. But the utility sector is actually in the all-time high mode. So why is it that if the market is going to recover back into all-time, if the sentiment is market has bottom, is going to recover to all-time high, things are going to be bullish, everything is like all rosy rainbows, like all ice cream and butterflies. I can't think of what I'm doing it. I'm doing this session in a live, okay? There's no script, so don't pay attention to my rambling. But if the market is assumed to have bottomed out and things are going to be all-time high, then why is it that the most defensive sector is making all-time high? So this is akin to traders trying to buy up as much defensive stock as they can while everything else is rallying in case like things start to fall back down. So it's more like a hedge. Okay, so if you look at yesterday drop, right? Yesterday US market drop, utility dropped the least, minus 0.11%. In fact, some of the utilities counters are, I believe, green. And consumer staple dropped the second least at minus 0.24. So these utilities and consumer staples are considered so-called the defensive sector. And if we look at the consumer staple also, right, it is going up quite although not as aggressive as utilities, right, it is still going up. So the common understanding is that if everything is going to be very bullish or whatever, then usually you will see a lot of funds going into things like industrial, financial, tech, consumer discretionary. You will see all these counter going up a lot aggressively compared to the utilities and consumer staples. But in this case, for the past 2 weeks, we have seen even the consumer staples and utility going up. So I can derive two possible explanation. One is that this is just a broad market movement, everyone buying everything up, so that there's essentially no explanation. And it can be also because like end of the quarter portfolio rebalancing by fund manager and institutional, and that is extremely obvious from how Apple is going up. So within this March, right, within March, Apple's fundamental did not change at all. In fact, Apple actually have a weaker fundamental because they say that they are going to reduce production or something like that. But the price still went up 11 straight green days. And it is a very clear sign of quarter end dressing, as you will say. But what I'm trying to say is if things are truly bullish, right, you will definitely see defensive sector like utilities being suppressed. It will go up, but not as aggressive. Okay, not as aggressive as what we see. In fact, right, the market rally, let's look at the S&P 500. Okay, let's look at the S&P 500. It actually start rallying somewhere around 15 March. So on 15 March itself, shortly before the FOMC meeting, is already the first green candle is there. Then after that, once the FOMC announcement came out, Jerome Powell say, okay, 25 basis point, then it just rally all the way. So the first day of rally is as early as 15 March, and then 16 March we have like a confirmation, and then the whole thing goes upwards. So when we look at the utility sectors, right, if we kind of look back at 15 March, that first week where FOMC announcement came out for the 25 basis point, it is kind of flat. Okay, now let's look at the tech sector. The tech sector actually rally all the way. Okay, tech sector actually rally all the way, and then the financial sector also rallies all the way. Consumer discretionary also rallies all the way. But utilities didn't really rally until like 24th March, 25th March, like last week lah. Okay, so it gives you a somewhat like a suspicious feeling that actually when the Federal Reserve first make the announcement, it is a true rally. It's a true rally where all the funds are suddenly going into the growth sector like industrial and tech and financial, consumer discretionary. But during last week, after that first week of rally finished, during the second week of the rally, which was last week, okay, there are a lot of buyings in utility also. There were a lot of buying in utilities along with technologies and financial. So it does seem that this second week of the rally, right, it seems like there's a lot more of quarter end dressing that's happening, but the financials manager or the institutional, right, they are also trying to hedge their dressing with defensive counters. So that's my personal feel lah. That's my personal feel. So we see how it turns out. We see how the market turns out. But if we are looking at like very clear-cut bearish sector right now, it is definitely the home builder sector. Okay. Next, the Russell 2000, Russell 2000 is something that I want to look at also. So it managed to break through and then it start to come back down already. So this is, I would say, like this level is definitely I will call it a hard resistance level lah. And I don't think this resistance can be broken again. It will definitely go down and then kind of like maybe stagnant some more. Who knows? But if you are a Russell 2000 trader, right, you might want to take note of this. Excuse me, burping. You might want to take note of this. Okay. So with a lot of counters diving left and right yesterday, right, there are some stuff that were quite green. It's actually those stuff that are related to the Russian conflict lah. So fertilizer company, the uranium company, and oil and gas is red. Oil and gas is red, but commodity companies, these are all in the green zone lah. So that's something that you want to take note also. We are talking about peace negotiation, but the stock market kind of like the stock market is kind of like we don't think so. We don't think the peace is over. We think something is still going on there. So you see some buying in this area lah. Okay, so that's what I want to kind of give you an update. So to give you my personal direction and what I am doing, right? Wait, let me bring up my portfolio. My portfolio still haven't changed from the last update that we have, which was a few days back only. It wasn't very long ago. My portfolio did not change much. In fact, it went up higher because my portfolio is a lot more weighted on the bearish side. Okay, so about 3 weeks back, my unrealized profit was like, okay, let's recap. Okay, so about 4 weeks back, my unrealized profit was 5,000, and after the rally began, right, after the post FOMC meeting rally begins, my portfolio went down to about 2,000. And then after that, recently it went back up to 3,000 because Google and MasterCard rally up. And then now it is back to 4,000, even though Google and MasterCard dropped yesterday, right? My portfolio actually went up from 3,000 plus to 4,007. So the last time you see this, I believe my unrealized profit was around somewhere 3,000 plus. So you can see Google from 1,000 over dollar profit now dropped to 916. MasterCard from, I'm not sure where I was at, but it definitely dropped lower. But my children place profit right all the way back up to 3,700. Again, last time we saw was 2,000 plus only. So if we look at children place, it is one of the longest short position that I'm holding. Let me just bring this up, okay, just to show you. So this short was given as early as January 27. In fact, I post this trade setup in public. I share this trade setup publicly, but we also have a Patreon subscriber version where there are more stop loss level, entry level, and I also share where I am exiting. So it was shared as early at 27. I'm still closing. I mean, I'm still holding. sorry, my bad. So yes, on, I believe Tuesday, was it Tuesday? Wednesday, on Wednesday, right? Children place actually dropped back down 8% on this big red candle alone. So that caused my that caused my profit to jump back up very high. But what you will notice is also that, I mean, regardless of whatever rally going on between March, right? Children place wasn't informed on whatever rally that was happening. Like, it's just diving lower and lower and lower. So when I look for shorts, right, these are the kind of shorts that I look at, in a sense that doesn't matter if market rally, if the counter is weak, right? Maybe it will rally by a bit, like what you see here. But overall, it's not going to break the previous high, or it's not going to create a higher high. It will still immediately dive back down. So these are the kind of shorts that I'm looking at. So I still have my Starbucks short, which is kind of like stagnant also. Starbucks shorts is here. We do see a bit of retracement here. We do see a bit of retracement is coming back up like this, but once again, it has not yet created a higher high or anything like that. So if I were to cut one of my shorts, most likely I'm gonna cut Starbucks short. But let's look at how this plays out. Okay. So I'm still holding that, but you will definitely see some rate coming in. But one of the other trade is also pool. Pool is the home builder counters that I have. So this one already entered. Okay. So in terms of my portfolio, nothing really changed. I definitely have a additional short position on the home builder sector already. So for me, right, for me personally, and for those who are trading together with me, we don't trade the index. The index, trading index is not the way to beat the market. What we trade is we trade the actual stocks, because stocks move a lot more than index. And sometimes even when the index is going up, right, there are still some stocks that is going down, you can short. Or even when the index is moving down, there are still some stocks that you can long. And when you long the right stock, or at the right time, or you manage to catch a good trend within the stocks, right? That stocks can move for 30%, 40%, and without leverage, you can easily get a lot of profit. If you are trading index, and if you feel that you can beat the index simply because you are using leverage, then that's a very wrong mindset really. Because let's say you have $1,000 and then you are putting down 5% margin to trade index, and you think that you beat the index by 20 times or something like that because of the margin, right? You are not really beating the index, you are actually using leverage. So what if on certain months that you lose money, or what if you long at the wrong time, or you short at the wrong time? Your loss is going to be equally as much as whatever leverage you are going to take. So it's kind of like very weird, because you can have a very small amount of capital, and then you will get very big profit from trading index because of the leverage itself. But you have to understand the contributing factor to big profit is the leverage. So because of that, when it comes to loss, the leverage is gonna rear its ugly head also. So if you, as a stock trader, if the only thing you trade is index, right, what I can recommend is go and sign up a margin account, and then dollar cost average using the margin account on the S&P 500 index. And then you will definitely have access to some form of leverage as well, but probably not as much as those CFD trader, but you still have some level of leverage nonetheless. And then I can tell you, most likely within the 1 year, right, you are going to outperform all the CFD index trader. All the CFD index trader, you are going to outperform them. And you also have that leverage on your end. But the most important thing is you can do that without lifting a finger. It's just passive. You just dollar cost average every month, and it's simply passive. You don't need to look at chart. You don't need to time your entry, time your exit, waste a lot of time. You can simply beat like all the CFD index trader just by doing a dollar cost average margin account. Okay, so that's something that I just want to point out, because I'm not saying trading index is wrong or what, but I'm referring to those who think they beat the index simply because they are on leverage. That's definitely wrong. if you want to beat the index by trading the index, right, you need to understand that you have to buy at the right time, sell at the right time. You have to, like, for example, if someone who just buy here and sell here, right, in order to beat that person, you need to buy here, sell here, and then short here, then cover here, and then sell here again, and then short here again. Then the guy that is holding through here, right, he just simply dollar cost averaging, and whenever the price go down, right, he's gonna reduce the amount that he are losing out simply by dollar cost averaging dollar cost averaging. Also, it's just similar to how you try to short and then try to buy back, but the other guy is just doing everything passive lah. Okay, so that's one fallacy that I want to point out lah. Okay, so that's basically my end of this session. Sorry, I forgot, I haven't say what I want to do. So going forward, I am not looking to long all the growth stock or the technology stock. Yes, maybe it will create some kind of a higher low here, but when it create a higher low, right, maybe I will look at what are the industry or sector that I can long, but definitely the growth area is not something that I'm looking at. When I'm looking to long, I'll probably look towards LNG counter or energy counters, or maybe some defensive counters, but not the growth sector. On the other hand, I will still be looking for more aggressive short those overpriced tech counters lah. So there are some counters that I already have in mind that is still waiting for the right price action. Excuse me, burping. And then I will short those counter lah. So I'm still on the bearish side. I'm definitely still on the bearish sentiment, but at this time, I'm definitely not fighting against the price action. I'm still not fighting against the price action yet. Of course, in terms of the home builder short, right? I'm not fighting against the price action. This is a very bearish. This is a very bearish price action now. Okay, so it's right to go into short. So you have to remember that the market index is not everything. Okay, it's like, hey, why you short home builder? It's like this one so bullish, but no, the home builder sector is quite bearish lah. So there's a lot more to stock than just looking at triple Qs and S&P and SPY and all these kind of stuff lah. Okay, pay specific attention to certain macro factors, pay attention to the news, pay attention to certain sectors, because sectors always outperform the market. Have a good day, everyone, and have a good weekend since we are coming into Friday already. Bye-bye.